Good morning and welcome to our workshop for Monday the 23rd of September, where we review the data and events happening this week. Before we go on to that, just a quick review of what happened last week. Equities, certainly European equities, FTSE was up modestly, just 13 points, 0.2%. Dow fared slightly better, about 75 points, about 0.5%. The real winner was the S&P 500 in clear air there, up 22 points, which is about 1.3%. Gold, topsy-turvy week following the surprise move or non-move from the Fed on Wednesday evening. Gold rallied sharply up to $13.75. It's drifted back quite a lot since then. Still up $24.50 on the week, just shy of 2%. Crude oil was a loser, about $3, just under 3% lower on the week. The euro was the real winner, up about 255, 260 points against the dollar, which is close on 2%. Sterling had been doing very well on the crosses, certainly in the run-up to the Fed no news last Wednesday. Cable still managed to put on 133 points, about 0.85%. So the news dominated by taper or no taper, more to the point. And I think the message that comes back loud and clear from that is don't fight the Fed. For some reason, the markets had very much got into the mood of rates normalizing, that the Fed had to taper. But actually, the Fed had consistently said that they would not taper unless employment conditions warranted it. And they also said that they would not allow US monetary conditions to tighten, would keep short-term rates near zero for a very long period, at least till 2015. So why did the markets choose to ignore or misunderstand the Fed? I guess, as I said, everyone knows that rates will eventually normalize and yields will rise in the bonds as the economy picks up. I think the problem is that the Fed had been saying one thing and the markets heard something else. So now tapering of QE is off. But the arguments and discussions will persist every month until Fed do actually carry out this tapering of the QE3. As I say, don't fight the Fed is the message that is loud and clear there. Fund managers know this, but for some reason they chose to follow the herd and believed in what the market was telling them more than what the Fed was saying. Equities, bonds, dollar all reacted quite sharply. US dollar fell. In fact, the US dollar has sort of maintained its losses from Wednesday evening. Equities and bonds sort of more of a checkered move since then. Equities have certainly given up quite a bit of their gains along with bonds. But we're into another week, so let's see what's happening this week. Overnight news dominated by a couple of events. Most of the German elections, very much a shoe-in there for the Angela Merkel and the Christian Democrat Party achieving the best result in 20 years, falling slightly short of an outright majority by 5 seats, but this is all factored in by the markets, so we've seen very little positive reaction in the DAX or the Euro, really, partly because I think they now need to form a government and looking for what's called a grand coalition. But it was noteworthy that Merkel's previous coalition partner achieved less than 5% of the votes and now has no seats in the Bundestag. In keeping with the groundswell of anti-Europe feeling across Europe, this fledgling party, Alternative for Germany, witnessed quite a surge in support, similar to our UKIP party here in the UK. Otherwise, news overnight's been fairly positive, really. We have had the report from HSBC on this very closely watched gauge of China manufacturing activity, which showed a 6-month high in September, which certainly beat consensus forecasts of 51.2 versus 50.9. Although not too much of an impact, really. Southern China has been buffeted by this typhoon Usagi, which really has resulted in a bit of a drop-off in liquidity. But nevertheless, the Aussie dollar has probably will be continue to be supported by improvements in the Chinese economy. So, post the Fed, what are we looking for? Well, it's non-farm payroll next week, but this week there's a little bit of a lull. We've already seen flash manufacturing out in Europe, where the outright Euro-wide number came in less than expected at 51.1, with both Germany and France missing their prelim or flash manufacturing numbers there. We've got quite a lot of chatter in the wires about the trade-off negotiations between the Obama administration and the Republicans. This is requiring the debt ceiling, which has to be raised in mid-October. So yes, it's all fiscal cliff, fiscal budget, fiscal news. They're going to run out of money. I mean, the whole thing is just not good for the US in general, but Obama has made it very clear that he won't negotiate with the House Republicans over the debt ceiling, and he's accused them of threatening to plunge the US into a default. But there you go. That's politics in the US at the moment. So the data out this week. For the rest of the week, let's just kick off. We've already had, as I said, the German elections. Mario Draghi is speaking later on this afternoon, 2 o'clock. When any central bank governor speaks, the markets have to be a little bit careful because it does have the potential to impact the markets there. We do have quite a lot of sort of medium impact numbers out this week, but I'm going to focus just on the high impact ones. We had the ZEW the other week. This is the German Ifo Business Climate Index, which is a very broad index of 7,000 companies. And we're looking for a further improvement from 107.5 up to 108.4. That does have the ability to move certainly the DAX, Euro stocks, and indeed the Euros. So that's something that needs to be watched at 9 o'clock tomorrow. And then we jump to the US data in the afternoon. On Tuesday, we have the consumer confidence data out at 3 o'clock. Important number, really. We've mentioned before in our workshops here that the confidence of the US consumer has been potentially dented by the rise in mortgage rates we've seen since May, when Bernanke first mentioned the idea of tapering QE. So that's something that's going to be watched quite closely. And indeed, following on from that, we have housing data out later this week, which is also particularly sensitive to those rise in rates, which is important to see. Nearer time, we have Wednesday, we have durable goods. It's a very important number as well, excluding all the big ticket items, aircraft, etc. The core durable goods number, we're looking for a rebound from the previous month at 1.1%. And then we have the first home sales data, new home sales on Wednesday at 3 o'clock. Looking for a recovery from the previous month. 422 is the consensus forecast there. Then we have the weekly unemployment claims on Thursday. Again, a continued trend improving employment picture, but is it strong enough to get the Fed to move? We're going to find out next Friday when we get the non-farm payroll next week. We then have pending home sales, another more housing data, which again I find is a very useful forward-looking indicator. A slight improvement from the previous month, but something that will be watched quite closely. And then to round the week off, we've got Mr. Draghi speaking again, although this is at a university in Milan. I'm not sure that will have much effect, but again, any central bank president, governor talking can have the effect to move the markets. Thank you very much for listening. We reconvene again on Thursday at 8 o'clock. In the meantime, good luck with your trading. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.